Before computers took over Wall Street, trading was chaos. Rooms filled with shouting traders. Phones ringing non-stop. Deals being made in seconds, with nothing but hand signals and paper. This was the heart of finance. Loud, fast, human, but everything was about to change. Because in 1971, a new system was introduced. A system that didn't rely on people. It relied on computers. And it would go on to transform global finance forever. This was Nasdaq. Back then, Wall Street was dominated by physical trading floors. If you wanted to buy or sell a stock, you needed a broker. That broker would go to the exchange floor, find another trader, and negotiate a deal. It was inefficient, it was slow, and sometimes, it was unfair. Prices could vary depending on who you knew. Information wasn't always transparent, and small investors were often left behind. The system worked, but it had limits. Then came Nasdaq. Unlike traditional exchanges, Nasdaq had no physical trading floor. No shouting traders. No crowded rooms. Instead, it introduced something completely new. An electronic network. Buyers and sellers were connected through computers. Trades were matched automatically. No middleman required. At first, many people didn't take it seriously. How could computers replace human traders? Wall Street had always been about relationships, intuition, and experience. Not machines. But Nasdaq had one major advantage. Speed. Trades could happen faster than ever before. And speed, in finance, is everything. At the same time, something else was happening. Technology companies were starting to rise. And they needed a place to list their stocks. Traditional exchanges were hesitant, but Nasdaq welcomed them. Companies like Microsoft and Apple found a home there. And that changed everything. As these companies grew, so did Nasdaq. More investors joined, more trades happened, and slowly, the balance of power began to shift. But not everyone was happy. Traditional traders saw Nasdaq as a threat. If computers could match trades, what would happen to them? Their role was being replaced. Their influence was shrinking, and for the first time, Wall Street was facing a new kind of competition. Not from another bank, but from technology itself. Still, the advantages were impossible to ignore. Electronic trading meant lower costs, more transparency, faster execution, and better access for everyday investors. What used to take minutes, now took seconds. And then, milliseconds. By the 1990s, Nasdaq had become the center of the tech boom. As the internet began to spread across the world, tech companies exploded in value. Investors rushed in, stock prices soared, and Nasdaq became the symbol of a new financial era. But that era came with risks. In 2000, the dot-com bubble burst. Billions of dollars were wiped out. Many companies collapsed overnight, and Nasdaq itself fell dramatically. It was a reminder that while technology can change systems, it doesn't eliminate risk. But even after the crash, one thing remained clear. Electronic trading was here to stay. There was no going back. Over time, even traditional exchanges began to adopt similar systems. The chaotic trading floors started to disappear. The shouting faded. The paper was replaced by screens. And the human element became less important. Today, almost every trade is executed electronically. In fact, many trades are now done by algorithms. Programs that can analyze markets and execute trades in fractions of a second. Faster than any human ever could. And it all started with a simple idea. What if trading didn't need to be physical? What if it could be digital? Nasdaq answered that question, and in doing so, it didn't just change Wall Street. It redefined how the entire financial world operates. Because today, when you buy a stock, you're not shouting on a trading floor. You're clicking a button, and behind that click is a system built decades ago. A system that replaced noise with code, chaos with speed, and humans with machines.